Hello everyone, season's greetings to one and to all. I am Kruti Chheta, Fund Manager, Fixed Income, and I'll be taking you all through the review of 2025 and outlook on the cues what we can look at in 2026. 2025 has been an interesting year of developments where there have been few on the expected lines and few totally unexpected. Let's speak from the fixed income perspective. 2025, the expectations has been that it would be a year of rate cuts, and it has happened so throughout the economies, while barring some such as Japan, where we've seen rate hikes for the right reasons. But barring that, most of the countries we have seen have gone for deep rate cuts, and we have seen that the central banks has been in forefront in the action. Similarly, we've seen action from the governments also, where we've seen some fighting the tariffs while some implementing the tariffs. Now, what are the impact of these actions in the fixed income markets? Let's just take a brief review of that. While the rate cuts have shown some impact in the shorter end of the curves in some economies, there has been lesser impact throughout the economies. The reason being that the markets have been concerned about high fiscal deficit, sticky inflation, and high debt to GDP ratios. These mostly are concerns on the developed markets. While the emerging market macros have been in better situation, we still have seen that the transmission has been missing, primarily due to the tariff concerns and the actions or the implementations and the results that would happen because of these tariff concerns, where we've not seen that the transmission has happened in the longer end of the curve. So what can we expect in 2026 for these markets across? While it seems like your rate cut cycle is done in most of the economies by the central banks, it's going to be a prolonged pause. But what can be expected is that there could be some market actions through quantitative easing. The inflation is expected to be volatile in the first half but settle in the second half, and we will see that more action will be on the central banks through the liquidity measures. On the government side, we would see that the geopolitical concerns and the tariff concerns would continue, but there could be some cues that could be taken from the negotiations that are taken in 2025 and some of the concluded negotiations that have happened for the economies across. Now, going on to the domestic markets, we started with head-on with very stable macros, be it inflation, be it growth, be it your fiscal deficit, or be it your CAD. We started on a very comfortable position, and we were one of the few economies that expected that we would get the trade deal first. However, things turned around for us in the mid of the year, but in the first half of the year, the things were very strong for us with the stable macros. We also saw RBI front loading the rate cuts and giving enough adequate liquidity measures to support the market. Therefore, these actions and consolidation led to a transmission in the shorter end of the curve, where we have seen that the yields have come down. At the beginning of 2025, we started with an inverted yield curve, especially on the corporate bond side, which we saw it steepening in 2025. Now, we have seen that RBI took action and continues to take liquidity measures. In consolidation, it gave 125 basis rate cut along with around 16 trillion of the liquidity measures, and still ongoing. The longer end of the curve did not see much of the transmission because of the two primary reasons. One, we did not see that the FPI inflows came in during the year. Second, we saw that there was a oversupply of SDLs, which led to higher supply and a mismatch in the demand supply dynamic. And third, we saw that because of the trade negotiations not being concluded as expected in the first half and some of the situation worsening, there was some of the volatility in the currency also, which led to sell-off in these markets. While the liquidity measures by RBI which has been taken has led to transmission in the shorter end of the curve, but as the liquidity in the system comes in and credit growth increases, there has been a double-digit growth in credit, but the deposit growth has lagged in the economy because of the low interest rate, and this has created a gap in the system, which has led to the issuances in corporate bonds, CDs, and CPs to bridge this funding gap. And therefore, we've seen that the transmission in the mid of the curve has been less, opening up a gap for the investors. So as we move into 2026, we sure enter with a stable fiscal, inflation expected to be in the target range, and a comfortable CAD which would be also carried forward due to lower commodity prices. But however, there could be some backlash due to your tariff negotiations not being concluded as expected or within the time frame, or there could be some backlash from the geopolitics which are ongoing, or the new ones which would come up in 2026. Keeping all this in mind, 2026 looks like a year of accrual, where the investors should be looking at a segment of a fairly 1 to 3 year segment. However, if we conclude a trade deal in line with expectations or better than expectations, and we get included in global bond indices, or we see that the global central banks go for quantitative easing, any combination of these factors may open up a gap for the duration segment also, and therefore that would call for a barbell strategy. So we enter the year where we see accrual picking up traction, but in event of any of the previous events playing out, we see that a barbell strategy could also be introduced during the year. So keep an eye out for fixed income. It still remains an attractive space and a strategic allocation. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.